And now I would like to turn today's program over to John Peacock. Sir, the floor is yours.
Good morning and afternoon, and welcome to today's web seminar. We've got a big audience this morning, and we're looking forward to talking to you about this exciting topic. Let me give you a quick overview of the agenda for today. I'm going to do some quick introductions, walk through an overview of NetSuite and the revenue management module, and then we'll spend the bulk of the time viewing a live demo from Joe Friedman. Time permitting, we'll end with Q&A. Today I'm co-presenting with Joe. I've been based out of our San Mateo office since I joined NetSuite from Oracle in 2007. I was in the professional services organization before I joined the product team 3 years ago. I'm responsible for understanding and evangelizing software industry requirements within the product organization to ensure that we're building the right solution for our software customers. When it comes to revenue, lucky for me, software companies have to also support processes such as the manufacturing and sale of hardware, delivery of service through PS organizations, etc., so the requirements actually span a fairly significant percentage of what our module offers. Joe is a distinguished solution specialist and has been at NetSuite for 5 years, originally on the East Coast but now working out of our Denver office. Joe has spent most of his time at NetSuite working with hundreds of software and technology companies, both as a solutions consultant and a senior industry principal in the software vertical, and last year as the director of the Finance Center of Excellence. Additionally, he's been a core member of the revenue recognition cell since its inception, contributing to everything from product design to feature testing. So hopefully most of you already know NetSuite, but if you don't, we were the first cloud company having been founded in 1998 with the goal of delivering a single cloud-based system to run a business. We have over 5,500 employees globally, and over 40,000 plus organizations and subsidiaries trust NetSuite to run their business day in and day out. We ended 2016 with almost $1 billion revenue run rate, and were acquired in late November by Oracle for $9.3 billion. Now we operate as a global business unit of Oracle. That underlies our application and really provides a strong foundation for what we do. On top of that, we have our market-leading ERP, CRM, services resource planning, and commerce system all built on a single unified data model. With OneWorld, we were able to handle difficult tasks of going global with multi-entity, multi-book, multi-language, multi-currency, and multi-country tax compliance. All of this has been critical for us in running our own instance of NetSuite. And of course, we use this all to drive our success across industries such as software, services, advertising, media and publishing, nonprofit, manufacturing, wholesale distribution, and retail, to name a few. And now before we jump into Joe's demo, I'll spend a few slides talking about the Advanced Revenue Management solution and how it's built to support the move to the new revenue standards. As I mentioned before, I focus on the software industry, and therefore I spend a fair amount of time discussing the complexities of revenue recognition. I like this quote because it reminds me to keep thinking simple. Even when the problem is fundamentally complex, breaking it down into simpler components generally leads to a better solution. And lucky for us, with the new revenue standards, the accounting boards attempted to make things simpler by converging the principle into the principle-based 5-step revenue recognition model. The same 5-step model applies to all industries, and even though not everything converges between them, to both US GAAP and IFRS. But in reality, the straightforward 5-step model exists within a much more complex overall process. This diagram shows part of that complexity, but even here we're missing the dimensions of additional sources, such as projects and subscriptions, and contract modifications that occur throughout the life cycle of a contract. Regardless, in the spirit of simplicity, we can at least start by focusing on the revenue process itself and break that down to ensure that it interacts with all of the associated inputs before determining what the output should be. And we arrived at this, at least at a high-level solution. While we didn't architect our solution specifically for 606, after all, we'd ideally like it to be flexible enough to have a fighter's chance accommodating the next revenue standard should one emerge, we can map the pieces of our revenue management solution to the 5-step model quite easily. Starting with the revenue arrangement transaction, which represents the contract with the customer. Inevitably, the contract will have actually been identified before the arrangement is created in NetSuite and will exist in the form of a sales order or some other source like a project or subscription. It is, however, important to note that you do have the option to have an approval workflow on the arrangement to give finance a chance to ensure accuracy before any revenue can actually be planned. Next are the performance obligations, which in many cases will map directly to source lines or activities, such as a sales order line or a project milestone. However, there can be hidden obligations that really only exist as elements within the arrangement and not in the source, such as a warranty. Elements define the item or service, the sales amount, default revenue planning information, and ultimately the revenue amount to be recognized for that obligation. We then determine the transaction price, which is the aggregate of the sales prices of all the elements. This can change over time if something changes on the source document, such as a correction to the quantity or rate, or if contract modifications occur where additional obligations come into play. Once the transaction price is determined, we allocate the revenue by leveraging fair value prices that are associated to the items or services. Fair value prices are based on fair value formulas, which can be as simple as a constant amount and as complicated as a function of the aggregated amounts from all associated obligations. For example, a support item might have a fair value defined as 25% of the discounted sales amounts for all licenses sold within a given product line. That formula can easily be created with a point-and-click interface. No code or customization is necessary. Fair value prices are also flexible in that you can stratify the fair value prices for a single item using up to 10 user-defined dimensions. You can also share fair value prices across items. For example, if you have multiple support items for different product lines that all have the same fair value price we mentioned before of 25% of the discounted amounts of associated licenses, you can share that single fair value price across all of those items. And then we recognize revenue, account for foreign exchange gain loss, and ensure that the contract asset or liability balance is appropriate. Critical to this process is that the revenue is planned based on events such as fulfillments, billing, subscription activation, or even user-defined events such as project task completion, so that there is no need to manually set dates. You can set the items and services to be aware of what activities should drive the start and end dates for revenue recognition, and not worry about having to override manually unless exceptions arise. And now for a few specific 605.15 requirements you'll be watching in Joe's demo. First, contract modifications. Revenue arrangements can be merged, and more specifically, individual elements of revenue arrangements can be merged to ensure that as the contract with the customer evolves over time, it is represented appropriately by the revenue arrangement. It doesn't matter what the source is. For example, elements tied to a project activity can be merged with elements from sales order lines. And once the merge is complete, you still have visibility into the structure of the original arrangements. Accounting for cost is an area that is also specified in the new standards, and Advanced Revenue Management allows you to track the costs and amortize those expenses directly on the arrangement. The cost to acquire a contract will be allocated to align with the revenue, and then flexible amortization schedules are leveraged to recognize the expense. And finally, everyone's favorite topic, the transition from current standards to new. We have a few tools that are leveraged here. First, Advanced Revenue Management is compatible with our multi-book feature, so you can set up a secondary book now to start accounting for and analyzing your contracts under 606 rules. We then have a migration tool that can be leveraged for both the full or modified retrospective methods. The tool is a process you run where you specify your transition period and a user-defined query that defines the contracts you want to reevaluate under the new 606 rules you set up. That process will determine the revenue delta between the old and new rules, post the appropriate amount to retained earnings, and replan the new remaining deferred revenue amount. The user-defined query gives you full control over which arrangements are evaluated, so you can exclude any that might qualify as a practical expedient. And once the process is complete, you'll have an easy way to identify the arrangements that have been reevaluated, and you'll have visibility into the before and after state of those arrangements. A few other quick notable features, and hopefully it goes without saying this is not an exhaustive list. The feature encourages a set it and forget it approach, whereby as transactions come in, you look for exceptions that need to be handled manually, but let the vast majority proceed touch-free. There will be the need to revisit the set it piece as your product lines and pricing strategies change, but fair value prices have dates that define when they are valid. So these activities can be planned, executed, and tested in advance to ensure that you avoid hiccups and interruptions. I mentioned auditability a few times, but it's worth noting again that changes to configurations as well as transactions are logged. The revenue transaction is tied back to its source, so you're always a click away for more detail. We have support for hidden and variable consideration obligations that may exist explicitly only in the revenue contract but not in the source. Advanced Revenue Management comes with a suite of pre-built but customizable reports, including Deferred Revenue Waterfall, Revenue Roll Forward, and Billing and Revenue Summary. And those reports, as well as our financial reports, have full drillability and visibility to the underlying transactions. And by now I hope I've provided you with a good background of the module and its capabilities. So it's finally time to turn this over to Joe so you can see it in action.
All right, everybody. Thanks, John, for the intro. Sorry, I just wanted to make sure we got everything set up properly on the WebEx. I'm just going to jump right into my demo here. I've got a lot of good stuff to show you. First, we'll start with the safe harbor slide. Everything I'm going to demo for you today is released in production. I may touch on the roadmap as we talk about some features, and the roadmap obviously is something that may or may not happen. So don't hold it against me if I say something about the future that doesn't happen exactly as I say it. That said, let's move on to the demo agenda for today. So as John mentioned, ASC 606 is a very big and very sophisticated and complex revenue standard that touches on all sorts of different rules based off of all sorts of different situations. And our Advanced Revenue Management module is a very sophisticated but very flexible and surprisingly easy to use tool to not only help our customers meet all the compliance regulations that they need to meet from the standard, but to really completely automate their end-to-end revenue recognition process, which will cut down on the errors that come with spreadsheets and the manual and tedious work that comes with having all of your RevRec schedules in different spreadsheets, as well as the auditability concerns that comes with having all your RevRec in different spreadsheets. So yes, we're here to help you maintain compliance with the new standards, but we're also here to really automate your whole end-to-end RevRec process. So the best way that I find to show you a lot of the features of the module, as well as link them to many of the requirements of 606, is just by going through a couple of use cases. I'm not going to be able to show you all the great things that our module does, and I'm not going to be able to touch off of everything that 606 wants you to do, but I think through these 4 sort of core use cases, we should be able to touch on quite a bit of our great features and quite a bit of what 606 requires of you. So the first use case we're going to go through is sort of what I just call a new business contract. We're going to kind of go through this from contract inception through multiple months of sort of revenue recognition activities and revenue recognition. We're going to look at all the different setup pieces. We're going to look at all the different reports, and really the goal of this first use case is just to really get a feel for the different parts of the process. And then our second use case is going to build off of the first one and really have to do with contract modifications and linking revenue sources. The third use case we're going to talk about is bundled performance obligations, as well as contract cost amortization or accounting for contract acquisition costs, which is a requirement of the new standard. And then lastly, we're going to get into dual reporting, using NetSuite Multibook to report and recognize revenue in both 605 and 606 in the same system from the same underlying source transactions. So just a little bit about use case number 1. Again, this is going to be a new business contract. We're really going to try to go through an end-to-end revenue recognition process. And the focus here from an ASC 606 perspective is really how the NetSuite objects tie to the 5-step model for revenue recognition, that was laid out in 606. Additionally, a lot of the disclosures and reporting requirements of ASC 606 are part of our out-of-the-box reporting that are, updated in real time and fully drillable to the underlying source transaction. So I'm going to spend a lot of time talking about the reports. And also in this use case, we're going to talk about accounting for contract assets and liabilities. So under the new standard, you're never supposed to have a negative contract liability or deferred revenue balance or a negative contract asset balance. You're supposed to constantly be netting them, and that's going to be something that we're going to touch on in this use case. One thing that I will say before we dive in is that this module is meant to solve the needs of many different types of companies and many different types of industries. I've sold NetSuite RevRec to digital publishers or to education services providers. That said, most of the use cases today are very sort of software company focused, mainly because Historically, they're the types of companies that use these types of features, and they also have a lot of great use cases that are very, demonstrative of the different things that I want to show. So I just will pause there and just say that, these use cases are sort of software contract focused, but the tools and the things that we're going to do can be applied to any industry and any type of contract. So outside of just 606, the one thing that I really want to kind of get across during this section is this set it and forget it, and then manage by exception nature of our engine. From a revenue management perspective, if I set up my revenue rules correctly, I set up my items or product records correctly, and I set up my fair value prices correctly, the whole revenue recognition process from that point on is going to be completely automated. The sales order will follow, an approval process, or any booking document will follow whatever its normal sales process is. It may be billed, it may be delivered or fulfilled. All of those processes happen independent of the revenue team. But because I set these things up correctly, all of the downstream revenue transactions will be completely automated, and you manage this by exception via all the different reports that we have that you'll see. And then the other thing I'm going to really kind of drill home, for lack of a better word, is the real-time drillability and visibility. From the financial reports down to all the source transactions, as well as the reconciliation between the financials and all the various revenue disclosures and reports. So those are really the things we're going to touch on this use case. Now, John already showed this slide, so I'm not going to spend a ton of time on it, but again, mapping those 5 steps to NetSuite objects in our Advanced Revenue Management module, the revenue arrangement is sort of where the magic happens. The revenue arrangement is the core revenue contract. This is only going to be created when a source transaction, such as a sales order or an invoice or a project or a subscription, has undergone some sort of approval routing, and it could be some sort of checklist-based approval, and then you can have additional approvals on the revenue arrangement. So that contract isn't going to be created until we're certain that whatever the definition of of a contract is to the company is met. But once that sort of that arrangement gets created, once those booking documents are approved, that becomes sort of the core central revenue object throughout this process. As far as identifying performance obligations, in NetSuite, our term of revenue element is what is going to be your performance obligation. They are the lines on the revenue arrangement. They may have a one-to-one relationship between lines on a sales transaction, and they may be bundled, or they may not have a one-to-one relationship with a line on the sales transaction. But when we're talking about identifying the performance obligations in NetSuite, we're talking about revenue elements. And then you've got the transaction price. So this transaction price is going to be a core part of the revenue arrangement, and it's going to be the total price of any linked revenue sources. So if I have one sales order, the total sales order amount is going to be the transaction price. If I have multiple sales orders, it's going to be the total between all of those sources. And then fourth, we allocate that transaction price across the performance obligations, or in our case, revenue elements. And we do this based off of their fair value prices. So fair value can mean best estimated selling price. It can mean VSOE. Basically, it is the amount that we are going to recognize regardless of what we're selling that performance obligation for. And we'll talk about that in great deal. And then lastly, step 5, satisfy or recognize revenue as you satisfy the performance obligations. These could be, this is really going to be tying to our revenue planning. We can trigger revenue plans from, as John mentioned, fulfillments, billing, user-defined custom events, but a lot of flexibility on how we satisfy step 5 of the 5-step model. And we're also going to talk about deferred revenue classification, or unbilled or contract liability classification, where we automatically account for unbilled receivables, or under 606 terminology, contract assets, or we automatically account for FX exchange gains and losses between, what we book a contract at and then what the exchange rate, may change to down the line. So really focused around the 5 steps, tying it to what the engine does is really the goal of what we're going to do in this first use case. So the last slide before we jump into the product is the key to remember here is as we go through this process, 3 things post to the general ledger. All right, NetSuite is a real-time system. We don't have subledgers. We have, all of our revenue module is the same database as our financials, is the same database as AR. Some of these objects post to the general ledger, some of them don't. But throughout all the processes, you'll see 3 things post to the GL. Invoices post to the GL. They always debit AR, and they always credit contract liability, or under old terminology, deferred revenue. I'm trying to use the new 606 terminology, debit AR, credit contract liability. There could be one minor exception where we just post directly to revenue on an invoice, but we're not going to talk about that today. For all intents and purposes today, invoices, debit AR, credit contract liability. Then there's the revenue recognition journal booking process. And RevRec journals always debit contract liability and always credit revenue. But notice that that piece is decoupled from billing. So I might recognize revenue in advance of billing, I might recognize revenue behind billing, but when I book revenue, it's always going to debit contract liability and it's always going to credit revenue. And then lastly, the last step that will post to the GL is what we call our revenue reclassification journal entry process. And it really does 3 things. And today you're going to see 2 of them. If in fact we've recognized revenue in advance of billing, that third process is going to automatically reclassify our negative contract liability to a contract asset. And I'm going to show you this. We're going to show it how it reflects in reports, but that's the first thing that step's going to do. And then it will degross the contract asset once billing catches up to RevRec. The second thing that this step does is if you only use one contract liability account or one deferred revenue account, it really doesn't matter that much. But if you like to have a different contract liability account for software and a different contract liability account for maintenance and a different contract liability for hardware, and we're selling all these things at one price and we're recognizing all these things at another price, the second step really just reclassifies our contract liability accounts to make sure that they always tie to the revenue allocation amounts and not the sales prices. So I know that sounds a little confusing. I think it'll make more sense when we look at it in the product. And then the third thing, which we're not going to talk about today, but again, if I book a contract at one FX rate and then my FX rate changes as that contract becomes realized or becomes billed, we're going to have adjustments to an FX adjustment account that will also affect contract liability depending on which way the FX change went. So, I know that was a lot. We're going to cover sort of a lot of different things in this first use case. We're going to go through it slow and meticulously, and then the other use cases after this one, we're not going to go through all the steps and all the reports like we will in this one. We're going to move through it a little bit faster. So that is the end of the slides for now. And now we're in my NetSuite product. And, this is going to be a very functional demo. I always talk about, and I'm sure some of you aren't overly familiar with NetSuite, but there's a lot of ways to navigate NetSuite. But one of the really nice features that we have is this concept of shortcuts. And shortcuts are basically bookmarks. You all use bookmarks to bookmark your bank account or your email or whatever it may be. Well, every page in NetSuite has a unique URL, and that allows us to bookmark it. So in your day-to-day life in NetSuite, you're going to use your bookmarks to do all the things that you do on a daily basis more efficiently. For me, I demo on a daily basis. So I'm going to use my bookmarks really to navigate through this demo flow as efficiently as possible. Also, another thing you're going to see is a lot of different tabs up on the screen. The great feature about NetSuite is the ability to open things in a new tab or a new window. So by having these tabs open in the top of the screen, it's going to allow me to move through this content a lot quicker. So with that said, let's get into it. Before we jump into the first use case, I just want to highlight these first 4 links. And these links are to a page of revenue recognition rules, items, my fair value price list, and then as an offshoot of my fair value price list, my fair value formulas. And the reason I want to show these things first is these are the setup steps that I need to take to make this all work. So my revenue recognition rules, my items, and my fair value price list. Now, I'm going to get into detail about the item setup and about the rules and about the fair value price list as we go through the use cases. But the point that I wanted to point out is all the use cases that I'm going to show today use one of these rules. All the use cases that I'm going to show today use one of these items, and all the use cases I'm going to show today use one of these fair value prices. And, you know, if you set these three things up correctly, you're going to automate this whole process, and you're going to be able to manage by exception. And we have lots of different types of rules, very flexible. We'll get into them in more detail in just a second. So setup steps, rules, items, fair value prices. And now the other thing I want to show you before we really dig into the use cases is the three core disclosure reports I'm going to be focusing on today. And that's the revenue recognition forecast report, that's the billing and revenue summary report, and then the contract liability roll forward report, or, you know, as you may understand it, the deferred revenue roll forward report under old terminology. These are three core revenue recognition reports that come in the module. And as we go through these use cases, I want to show you how they update in real time, how they drill down to the underlying transactional detail. Now, when we go through the individual use cases, I've got these things filtered, so we're only focusing on one transaction at a time. But I wanted to just give you a view of the report with a lot of transactions because that'll give you a better feel for what you'd be looking at, you know, when you're, you know, working through these reports. The other thing that I wanted to point out is, as with any report in NetSuite, these reports are configurable. So right now I'm looking at my revenue recognition forecast by customer. You know, if I wanted to view my revenue recognition forecast by revenue account, or if I wanted a separate report, I can simply configure the report, slide revenue account over, and now I have that same exact report, except instead of grouped by customer, it's now grouped by, you know, revenue account. And that's just by, you know, sliding and grouping a column a little bit of a different way. So any of these reports that I'm going to show you can be sliced and diced in all sorts of ways. And any of these reports that I'm going to show you are going to be updated in real time and drillable to the underlying transaction. So that's just sort of an overview of the three core reports that I'm going to show today. We talked about the three major setup pieces, and we'll talk about them more. The last thing that I want to show before we jump into the use case itself is, you know, if I look at my shortcuts, this create revenue recognition journal step and this create revenue reclassification journal step. So as I mentioned in the slide deck, three things post to the GL. Invoices post to the GL, AR and deferred revenue, and revenue recognition journal entries post to the GL. Now, you can book revenue monthly, you can book revenue weekly, you can book revenue daily. I can book revenue for all of my customers at once, or as you'll see in my demo today, I can filter for a particular customer and recognize revenue for just a particular customer. Now, today, I'm going to be booking revenue and reclassifying revenue at the customer and transaction level because that is what will allow you to really see what's going on the best. But in real life, you are likely going to schedule these processes. So the revenue recognition, booking revenue recognition entries can now be scheduled. Reclassifying revenue recognition entries can now be scheduled. This can be a completely no-touch process, or it can be manual at a very large customer group level or at smaller customer group levels. But you know, I just want to make sure that you point out that some of the steps that during my demo I press a button to show you how it works can be completely automated via this scheduling process. So that said, we talked a little bit about setup, we talked a little bit about these reports, and we talked a little bit about the rev rec and the reclass process that we'll do manually throughout the use case. Let's get into the actual use case. So I'm just going to close down this report, and what I'm going to do now is I'm going to open up this report. So this is the revenue recognition forecast report, but this is filtered for just one particular transaction. And I've got the filtered dates here from April to March 2018. And the reason I've got it up like this is because I want you to think of this as if I'm a revenue manager right now. I'm at the end of April, and I'm kind of looking at my reporting for the month to figure out, what's going on for a revenue recognition perspective. And assuming that I only have one transaction in the whole system, which is unlikely, but in the case of the demo, that is what it is, I can come to this report and I can see that I've got, revenue arrangement 395 for customer A1. I've got my subscription revenue that's been planned over 12 months. I've got some training classes where it looks like I'm planning some revenue in April, and I've got some forecasted revenue in May, and I've got some professional services that it looks like is linked to a project record, and I'm recognizing a bunch of that revenue in April, and I'm recognizing a bunch of that revenue in May. So that's just me looking at this thing at the end of the month and seeing what the report looks like. Now, I can drill into the underlying transaction from that report and come directly to the revenue arrangement. Now, as I mentioned before, this is the core piece of this whole entire process. But I'm going to come back to this piece because what I want to do now is drill from the revenue arrangement down to the very most source transaction, which in this case is the sales order. So mind you, we started at the revenue recognition forecast, drilled down to the arrangement, and from the arrangement, we drilled to the sales order. Now, let's just talk for a second about this sales order. So I'm looking at this sales order now, and, depending on what type of company you are, your sales orders are going to look different. And as John mentioned, we can have multiple types of sources for revenue arrangements. It can be sales orders, it can be invoices, it can be journal entries, it can be projects, it can be subscriptions. But in this case, the source for this revenue recognition, revenue arrangement is a sales order. And what I have here is I have a one-year contract. I've got some segmentation, my subsidiary, my cost center, my location, my product line, all at the header level. And then I have my products. So what I'm looking at here is two subscription items priced at $2,400 and $1,200 per year per user, respectively. I've got some inline discounting, and I've got my total contract amount for those subscriptions. I'm going to bill them up front. And then I've got some contract information here, contract dates, my contract start date, my term, and my contract end date. Now, that could be from the contract renewals module. That could just be some custom fields that you have on your sales order to designate a contract term. The point is that's not inherently RevRec information. Nothing on this sales order is inherently RevRec information. But I can use that information to populate revenue recognition dates if I want to. And I'm going to use the information on these items to automate RevRec as well. So the first part of this contract is our two subscriptions that are one-year subscriptions. I also have training classes. So I'm going to sell 10 training classes at $1,000 a pop at list price. I've got some inline discounting for a total contract amount of $9,000. I'm also going to bill those up front because those aren't really term type items. I don't have any contract information. And then lastly, I've got my implementation services, 80 hours at $500 an hour. I've got some inline discounting for my discounted rate of $400 an hour and my total contract amount. Now, I want to point out that I also have a project record linked to this line. And I just want to say there's all types of ways we can recognize revenue for projects in NetSuite. We can do percent complete. We can do, a percent complete override. We can do time against time. We can do milestone revenue recognition based off of project completion. We can do all sorts of different project-related RevRec rules on billing, et cetera. For the purposes of this, I am just going to use a very simple, what we call percent complete override schedule, where I just plug in April 85% and May 100%. You can do this as well. There's other ways we can recognize revenue for percentages. We can use an event, a custom event for percentages. We can do all sorts of things. But for this use case, I'm keeping it simple, and my project RevRec is going to be percent complete based off of the override amounts I put into this project record. So I'm going to close the project record, and that's all I'm going to talk about that. Just know that there's a lot of ways we can recognize revenue for projects. In this case, we're using these percent complete fields on the project record. All right, I also want to just point out the billing schedule. I'm billing these 3 items up front, and this is going to be billed when this project is completed. So if I look at my billing schedule tab, I can see that I'm billing $32,400 up front on 4/1, and I'm billing $32,000 in May. All right, so none of that is inherently RevRec information, right? That's the billing information. We have all the sales information on here. We have contract information. There was some RevRec stuff on the project, yes, that I put in for simplicity's sake, but other than that, none of this stuff is inherently RevRec. This is just the sales process. But remember, I said that you set up 3 things to make this process automated. You set up items, you set up fair value prices, and you set up revenue recognition rules. So for the purposes of this transaction, I've got 2 subscriptions, training classes, and implementation. And if we look at my list of items, I can see that I've got some configuration, I've got some field selections on the item record. And you'll see that for my subscriptions, I've got my subscription revenue account, I've got my subscription contract liability or deferred revenue account. And I'm going to recognize these even periods over the contract term. Now, I will prorate this if it's a partial month term. So if my contract term was April 15th to April 14th the following year, I would prorate the first and last period with even periods in between. That said, we can also do exact days of the month as well. So in this case, it's an even periods prorate, and I'm going to trigger those rules when my revenue arrangement is created. So in this case, that'll be my contract start date. Okay. I also have some training classes. All right. I'm going to recognize my training classes. So this is my training class item, and my revenue recognition rule for my training classes is to recognize it as I fulfill them to the customer. So it's going to be based off of the fulfillment events, and it's going to be based off of the quantity delivered divided by the quantity sold. Additionally, because that's going to be some variable amount that we don't know, I can also set a forecast rule here to just say I want to forecast my revenue evenly over 2 months because that's how I expect to deliver these training classes. And then lastly, I've got my implementation services with my percent complete rule set up on that item record. So we create our rules. I just showed you of even periods prorate, event quantity delivered, and percent complete. And we have all sorts of different types of ways you can create rules based off of different events, different terms, different start and end dates. I can't get into them all. Just know that we can create very flexible revenue recognition rules. And then we tie them to the item as well as with some other information. And all of the item level configuration you need to see is right here. It's just a couple fields, including the rule, all the fields that I just showed you in that list. So we set up our items, we set up our rules, and we set up our fair value price list. So in this case, I see I've got a fair value price for each one of my items. Now, in my case of my subscriptions, I have a distinct fair BESP price for each subscription, and I've got a formula. So basically, my fair value is going to be my BESP price, my estimated sales price of $19.20 times the quantity sold divided by 12 times the contract term. And the reason that we build in that divided by 12 times the contract term is so if we have a partial term upsell or downsell, we can use that same fair value formula that will take into account, the partial term upsell or downsell because we're annualizing that fair value price. Also notice that we can have things like upper and lower acceptable thresholds. So, if the sales price falls between the acceptable thresholds, you can use the sales price. If it falls outside of the acceptable thresholds, use the fair value price. So that's how we're calculating fair value or on our subscriptions. On our training classes and on our implementation, these aren't sort of term type of pricing. These are perpetual pricing. So we're just going to take the BESP or the best estimated sales price, and we're going to multiply that times the quantity. And so those are our 4 prices for our 4 items. And because we set up those prices, we set up the items, and we set up the rules, all of the RevRec is completely automated. Now, we're going to show you other types of fair value prices where you can just calculate a percentage of the transaction price. These prices can be imported. You know, we can calculate these in all sorts of different ways. We could have multiple prices per item based off a dimension, and we can also lump a bunch of things into a revenue category. But the point is, we set up the items, we set up the fair value prices, and we set up the rules. And now we can look at everything that was automated in this use case. So again, I look at my sales order, and I look at my related records, and I see on my related records, I have a revenue arrangement, I have an invoice, and I have an item fulfillment. Remember, I'm looking at this at the end of the month. Now, let's talk about the revenue arrangement first. I drilled down to that revenue arrangement from the revenue recognition report, but remember, this revenue arrangement is the core record of this whole thing, and it's created completely automatically because I set up everything correctly. And we'll see in later use cases me create this on the fly. For the purposes of this use case, I've already created it. But when we're talking about the 5-step model for RevRec, you know, this really is our identified contract. This revenue arrangement isn't going to be created until all of our approval workflows have been properly routed on the source transaction, as well as any approval workflows on the revenue arrangement itself. And I can see all the source transactions that make up this revenue arrangement. Right now, it's only one source transaction, but you'll see later we're going to have multiple source transactions linked to this one arrangement. So step one, identifying that contract, and this revenue arrangement signifies that contract. Step two, really identify your performance obligations. Now, we mentioned that our performance obligations in NetSuite are called revenue elements. And in this particular use case, we have a one-to-one relationship between our elements and the items we're selling. But from a sales perspective, we can see where the elements were sold on, the source transaction. This is all dynamic. I can open these transactions up from here. I can see the item we sold, the quantity we sold. If there's any FX, I would see the FX rate. And then we come to our sales amount. So step one was identify the contract. Step two, we identified our performance obligation. Step three, identify the transaction price. So in this case, our transaction price is the total sales amount from just our one source transaction. You'll see later that transaction price will be updated if we merge linked transactions. And then step three is allocate the transaction price across the performance obligations. So this whole section here is where you see that happening. Even though we sold this for $15,600, based off our estimated selling price of $19.20, our calculated fair value was $19.2, and our allocation amount was $16,754. Even though we were selling this for $32,000, our allocation amount is $31,414, and I can see my allocation ratio there. So step four, completely automated, completely taken care of by allocating that transaction price. And if I look on this allocation detail tab, I can see even more information about the allocation. I can see all the high and low calculated values. I can see how we got to the allocation. I can open up the formulas. I can open up the fair value price records. I can search on this information. I can report on this information. So tons of detail around the allocation and how we came to the allocation. And then step five is really recognize revenue as you satisfy your performance obligations, and that's really this part of the revenue arrangement right here. So we can see for each performance obligation, I have a revenue recognition rule. Remember, I already showed you these were set up ahead of time. Even periods for my subscription, and we just used my contract dates from the sales order as my start and end date. Okay? For my training classes, we are using the based off of the quantity delivered when we fulfill them, and we're recognizing that into my training class account and my contract liability training class account. And then on my services, we're recognizing that percent complete, okay? So that's really step five. All 5 steps, all contained right here on the revenue arrangement, all automatically calculated based off of the fact that you set this up right to begin with. And again, now I'm looking at this thing at the end of the month, and I can see that I actually have planned revenue for my training classes. So that must mean that I've fulfilled some of these training classes. And sure enough, I have an item fulfillment for 5 of my 10 classes on April 19th. And that's why when I'm looking at my revenue arrangement and I've got the amount of 7853, well, since I fulfilled 5 of 10, 5 divided by 10 times 7853, I've planned 3926. Now remember, we forecasted this based off of an even period 2-month schedule, and that's why we have some of it forecasted. And then the rest of that planned revenue is coming from our percent complete schedule. And not only can I look at it in this view, but I can press View Revenue Plans here, and I can pop open any of these schedules right here from the revenue arrangement. And here we can see our schedule for our subscription. Here we can see our schedule for our percent complete on our professional services. So I just want to pause. I know I just covered a lot of ground, but remember, I came in as a revenue manager at the end of the month. I saw my revenue forecast. I drilled into my revenue arrangement. From there, I drilled into the sales order. I looked at all of the things on my 1-year contract. We talked about how we set up the items. We talked about how we set up the rules. We talked about how we set up the fair value prices. And because we did all that, the revenue for April was planned automatically, and the arrangement and allocations was all created automatically. And I haven't done anything. I haven't had to touch anything. All I've done was evaluate. Now, if there was exceptions, I could take some action based off of the exception. But assuming that there are no exceptions, at the end of the month now, the only steps that you need to take are to create your RevRec journal entry and create your revenue reclass journal entry. Okay, so now, again, this could be completely automated, no touch. And you could do this for all your customers at once, but I'm going to filter it for this one particular customer. I see my subscription items. I see half my training. I see my 85% of my percent complete, and I mark that all. Actually, you know what? I skipped a step. I apologize. Before I create that entry, I want to show you one other thing. On this sales order, I also have an invoice, all right? That invoice was the upfront invoice for my subscriptions and my training classes. If I open that invoice and I look at the GL impact of that invoice and all GL posting transactions in NetSuite, you can view the GL impact. I see that it posted to accounts receivable, it posted to deferred revenue subscription, and it posted to deferred revenue, or I'm sorry, contract liability, subscription, and training classes. So remember, my 3 things that post to the GL are my invoice, my RevRec journal entries, and my revenue reclass journal entries. So before I book those reclass journal entries, but after I build, I can see all of my planned revenue here. On my billing and revenue summary, I can see that I've booked 64.4, I've billed 32.4, my billing backlog is 32,000, my total revenue backlog is 64,400, and my net contract liability or deferred revenue is 32.4, and that again is based off of the invoice. I can look at my contract liability roll forward report, which shows all the new transactions. That was the invoice for 32.4, and my ending contract liability for 32.4. And then, of course, this all ties to my balance sheet. This is a balance sheet filtered for this customer. I can see my AR for 32.4, my contract liability for 32.4. And income, I'm not going to have any income because I haven't recognized revenue. So my invoice posted to AR and deferred revenue. Now my RevRec journal entry, if I just press Create Journal Entries, that's the second thing that posts to the GL. And if I open that journal entry, I can see debiting my deferred revenue or contract liability and crediting revenue. All right, so that step would have been scheduled most likely. And then immediately afterward, as a second scheduled step, I'm going to reclassify my revenue. And if I hit that button, what you're going to see is I've got 2 journal entries here. I have a carve-in, carve-out journal entry, which is basically just adjusting my deferred revenue accounts to tie them to the allocated amount as opposed to the sales amount. So I can keep track of my different contract liability or deferred revenue balances. And the second journal entry the reclass step did was automatically reclass my negative contract liability to contract asset. Because when we looked at this order, I'm not billing this $32,000 until May 15th or May 16th. But I recognized when I booked my revenue, I recognized well over that amount, well, 353 over that amount, which gave rise to my unbilled receivable or my contract asset. So all of those parts happened completely automated, and now we can look at the effect that that had on these reports. So for one, if I look at my forecast report, I can now see my April amounts for my subscription have been recognized, my training class has been recognized, and my services have been recognized. I update my billing and revenue summary report. I can see I've got $32,723 in recognized revenue now. My backlog has gone down to $31,676, and I have a contract asset of $323,58. All right, if I go to my RevRec forecast and I look at just recognized revenue, I can see that my $32,723 ties to my $32,723 on my billing and revenue summary. On my contract liability roll forward report, if I hit refresh, I can now see my $32,723 in recognized revenue. I can see that I have a contract asset of $323. I have a contract liability of 0, and I have my net contract asset is $323,58. Everything's tying out. I go to my balance sheet and I refresh it, and again, $32,400 in AR, $323,58 in contract asset, 0 in contract liability, $32,723 in net income. And then I refresh my income statement that I have filtered for this customer, and there's my $32,723,58. So again, I set things up properly. The sales process just happened. My order got billed, my order got fulfilled, all my reports updated in real time. I simply ran the RevRec and reclass process, and all of these reports then updated in real time. And I can drill into this number from my income statement. From there, drill down into the journal entry. From here, drill into any one of the source revenue plans. From here, I can see that that journal entry was posted to the plan. I could drill back into the plan. It's keeping track of where I am recognized, what I have left to recognize. From here, I can drill back into the element. From here, I can drill back into the arrangement. From here, I can drill back into the sales order. And from there, I can go anywhere. But the point is that from the moment I posted that RevRec journal entry, my income statement updated in real time, and I was able to drill back all the way down through all the related transactions all the way back to the source transactions. So that was April. I know it was a lot of talking, but hopefully you realize I didn't press many buttons. Now, if I come in here for May and I go to recognize my journal entries in May, I'm going to see that I've got my subscriptions and my implementation, but I don't have any training classes. And that's because I didn't fulfill the remaining amount. And because that's a revenue event-based schedule, if I come in and fulfill, or my fulfillment person comes in and fulfill, it's not something the revenue person will do, but that fulfillment in May, in real time, is going to then trigger the fact that I now have the rest of my training classes to recognize in May. If I look at my forecast and I just go back to all revenue, you'll see that I no longer have forecasted revenue for training classes. I now have only planned revenue and recognized revenue for training classes because I delivered it and I planned it. The other thing that we need to do, or what our sales team, our billing team would do, our revenue team wouldn't do this, is create the next invoice, this completion invoice for my services. So again, this invoice is going to be one of the few pieces that post to the GL. And when it posts to the GL, my deferred revenue or my contract liability is going to finally catch up to my RevRec. So again, when I go, and I'm just going to close some of this stuff down, when I go to book my revenue at the end of May, so my invoice posted to the GL, now I can book all of my May revenue, or my schedule would book all of my revenue. And now my schedule reclasses my May revenue. What you'll see is we've now automatically unwound the unbilled receivable. So we've degrossed our contract asset. Now everything's in deferred revenue. We've also reclassified the remaining little bit of our deferred revenue or contract liability to tie to the allocation amounts. So now we've gone through 2 full months of RevRec. We've recognized all of our training because we delivered all of our training, and we recognized all of our professional services because it was on a % complete schedule. And when we look at our reports again, and I just hit reload, I can see that all of our revenue is recognized except for what we have planned in our subscription from June until March. Okay? And again, you know, I can filter this and just view recognized or just view planned revenue, and I can see that through the first 2 months, you know, we've recognized 43,456. Of course, if I refresh my billing and revenue summary now, we've got my 43,456 in recognized. We have my backlog of 29,443 and my contract liability of 29,443. I can update my roll forward. And what you'll see now is that all of our, it's all in contract liability, and our net contract liability is 29,443, which of course ties to 29,443. The 43,456 ties to what's been recognized. That's all going to tie to my balance sheet, which I've filtered for this customer. There's the 29,443 all in subscription. Here's our net income. And then of course, our income for May is going to update as well and tie to the 4. So we have complete reconciliation between the financial statements, between all of these RevRec pieces, and full drillability down to the underlying transactions. And I didn't have to do anything. I just set it up and ran the 2 processes. So that's going to flow. I'm going to leave this open. I'm going to leave this open. I'm going to leave this open. And I'm just going to move this back to all. And that's going to flow right into my second use case. So my second use case, and this is going to take much less time, but my second use case is around contract modifications. So a key part of ASC 606 is accounting for contract modifications, and you could have a contract modification from an upsell or a return. You could maybe just have multiple sources, you know, that on different transactions that you need to combine for RevRec purposes. You might have to edit a source transaction. All of those can give rise to a contract modification. And NetSuite, out of the box today, can meet 2 of the 3 types of contract modifications under ASC 606. They can treat it, the contract modification or the additional, you know, transaction as a separate contract, or we can support merging them into a single contract and doing a cumulative catch-up. And shortly, we will be able to do the 3rd and final way, which is prospective. In fact, in our last 17.1 release, we built the underlying technology here. We didn't release it because we wanted to make sure it worked properly for all these different use cases, but we've been testing those use cases, and as far as I know, it's on track to be released in our next release. So again, you know, safe harbor statement, but we will support all 3 major types of contract modifications, and we currently today support 2 of them. So that said, I'm just going to go right back into the product, and what I'm going to do is I'm just going to leave our RevRec report open for our customer that we've been working with, and our billing and revenue and our roll forward. And I'm just going to go to my shortcuts, and I'm going to open up this shortcut that says upsell order and merge revenue arrangements. So first off, we have another transaction for the same customer. And there are many ways that you can manage whether or not you have to evaluate contracts for a contract modification. And they're basically going to be based off of your own specific sort of criteria. Is it time ordered between the two? Is it the same customer and the type of products that they're selling? But we can set up different alerts and searches so you can evaluate multiple contracts for the same customer and then determine if they need to be merged for one for a particular for one revenue contract. Now, the guidance kind of says, book a separate contract, assuming that when the change is comprised of the addition of distinct goods or services at a price comparable to their standalone selling price. So let's say that we have this order for one additional subscription license. It's a coterminous upsell for 10 months. It's for the same customer. It's one additional license. It's deeply discounted. And when we approve that, and we would have undergone some sort of approval workflow, and we can go ahead and bill that, but we're basically taking this coterminous upsell, and the default behavior would be to recognize this as a separate contract. So you'll see that sales order that we just approved and billed already has a revenue arrangement attached to it. That revenue arrangement has already planned this revenue. And if we look at my various reports now and just hit refresh, you'll see that under the same customer, we have a separate revenue contract, and we're just going to recognize that on a go-forward basis by default. And then I can refresh my billing and revenue summary and see that it's going to have both orders now that we're going to track, and my contract roll-forward detail is going to have both orders now. But the point is that the default behavior is that it's going to create a separate contract. Now, you can determine if you need to use the cumulative catch-up process to merge these things. But once you do that, you can come in here, and there's this merge page, and I loaded a little early, and I'm just going to let this load really quickly. It's getting a little hung up. Sorry. So basically what this is doing is this is going to pick up all of our performance obligations for all arrangements across this customer, and it's going to allow you to then merge whichever performance obligations you want to. And there we go. So now I can see my original arrangement. I can see my upsell order. I'm going to go ahead and mark all and press merge. And what we're now doing is we're taking our original contracts and we're combining them into one as if they were one contract from its inception. And we've now loaded our new contract. And when we talk about the 5-step model on our merge contract now, and I'm just going to wait for this to allocate. Here we go. We now have a contract which is made up of multiple source transactions. So you can see sales order 235 and sales order 2536. I can see the prior arrangement, revenue arrangement 395 and revenue arrangement 400. I can see that this arrangement is a merged arrangement. I can see my transaction price now includes the total sales price of all source transactions. And I can see when we allocate my transaction price, we're now allocating the transaction price based on if this was one entire transaction from the beginning. And what that's going to give rise to is if I look at these revenue plans, you're going to see that there's going to be changes posted in April and May, because if this had been one contract from the beginning, we would have recognized different amounts. And then on a go-forward basis, it's corrected. Now, I can also see that I have previous revenue plans. So we have full auditability and history versioning, so I can see what my revenue plan looked like before the merger, and now I can see what my revenue plan looks like after the merger. I can also see, if I look at my revenue forecast, that now these two separate contracts have been combined into one. And I can see these delta amounts posted for my plans that had cumulative changes based off of the arrangements. Now, there are a bunch of different ways that we can track, we can book those catch-up, do the cumulative catch-up. We can use a catch-up period. But one of the ways we can do that is when we go to book revenue now. So when I go to book revenue for June, I can just include prior periods, and now I can see all of my scheduled changes for April, all of my scheduled changes for June, and all my scheduled revenue for June, and all of my changes for May, and I mark all, create the journal entry, and then again, this could be scheduled, but I run the reclass process now for the merged order in June, and what we've now done is we've gone through 2 full months of RevRec activities on the original contract. We booked a new order. We decided that we needed to merge them. We merged them, and we did all the revenue recognition for June. And now when I refresh this, I can see from my merged arrangement everything that's been recognized. I can see that we've got clawback in June to make up for what we had to do a cumulative catch-up for on my services and my training classes. All of this, of course, is going to tie to my billing and revenue summary. All of that 267 is going to tie to my contract roll forward report when I reload that, 2267, which will tie to my balance sheet. 2267, 44732, of course, will tie to my income statement. So that was a full 3 months of revenue recognition and reclassification across 2 transactions that we merged. Again, I know that was a lot of different stuff, but if you noticed, we weren't entering any data. All we were doing was evaluating the data and pressing a button that you don't even technically have to press. So that takes us to the end of use case 2 contract modifications. All right, so let's just keep going. I am going to close all this stuff down, and I'm going to go to my shortcuts, and I'm going to open up UC3. I'm going to open up my RevRec forecast for UC3 and my income statement for UC3. I'm just going to change the period here, and I'm going to jump into my PowerPoint really quickly. But UC3 really has to do with bundled performance obligation, as well as the amortization or accounting for contract acquisition costs. So in the first example that we did, the 5-step model, really every line on the sales order tied to a performance obligation or a revenue element. But the new standards say that doesn't necessarily be the case. Sometimes you are going to have bundled performance obligations, but you still have to separate them for RevRec. Additionally, there's a whole piece about allocating contract acquisition costs to contracts and recognizing them based off of the same, the same term or over the renewal period. There's a bunch of different ways that you may or may not have to do it. So I'm going to highlight the functionality in this next use case that we have in NetSuite to meet sort of these 2 requirements of 606. So this is going to be way less involved. This should only take a minute or 2. But what I want to show is I have a revenue recognition forecast with no data available. And the reason I have no data available is because I don't have a revenue arrangement for this use case yet. I also have an income statement with no data available. That's because I don't have any income for this use case yet. And I have a sales order. Now, this sales order is in a status of pending approval. And until it gets approved, we won't have a revenue arrangement. But what you see on this sales order is I have a software bundle, and I'm selling this software bundle for $120,000. I'm billing it up front, and I also have a term on some portion of that bundle of 12 months, okay? So when we talk about the setup, we talk about the items, the RevRec rules, and the fair value prices. So on my item, I can now see that I have a kit, which is software bundle, except I'm going to expand this for revenue management, which means that none of the RevRec will happen at the kit level. It's going to all happen at the component level. And my bundled obligations are perpetual license, maintenance, and I'm carving out revenue for an SLA provision. So this is sort of like a variable consideration item where, you know, I have to provide this service level agreement, and I have to defer some of that software revenue because if I don't, you know, hold up my end of the bargain on the SLA, I might have to give them some money back. But once the expiration happens on that SLA, I can recognize that revenue. So we have these bundled obligations, and each one of these obligations has its own rev rec rule attached to it. So we're going to recognize my software license up front. We're going to recognize my maintenance from 12 months from the event date, which in this case is just revenue arrangement creation. So my maintenance, even though we're only selling a bundle, we're going to recognize part of it up front, part of it over 12 months. And then my SLA provision is going to be a 12-month expiration. So basically, you know, it's a 12-month expiration, and we'll be able to recognize it after the 12 months happen. So we've got my items, and we've got them bundled. We've got our rules. And then we need our fair value prices. So if we look at our fair value price list, the thing that I wanted to show you that's a little bit different than the last use case that we had is that I'm actually calculating each one of these prices as a percentage of the transaction price. So my transaction price is 120. I'm going to calculate my fair value for my license at 80% of my transaction price, which is my BESP of 80 divided by 100. Times my transaction price. And this is just a simple formula that you can make with point and click in NetSuite, no custom code or anything. My maintenance, 20% of my transaction price. And then my SLA provision is going to be calculated at 2% of my transaction price. But the difference is I'm going to actually carve out the full 2% and plan that at the expiration date. And then the other remaining part of the transaction price is going to be allocated based off the relative fair value of these two fair value prices. So we set up our items, we set up our rules, we have our fair value price, and watch what happens when I press approve on this transaction. So I'm going to approve it. You know, I could go ahead and bill it if I want to, but because I've set up my items, because I've set up my rules, because I've set up my fair value prices, my revenue arrangement has already been created. And when I look at my revenue arrangement, I can see it's taking the 120 and it's allocating 80 of the 120, which is a calculated fair value of $96,000, 20%, which is a calculated fair value of $24,000, and 2%, which is a calculated value of $2,400. Now remember, I'm just carving this $2,400 out, so we're actually planning a full $2,400. The remainder, we're allocating across the relative fair value of my perpetual and maintenance. And when we look at what that looks like on our forecast report, I can see that even though my sales order looks like this with one item for 120, I'm recognizing 94,080 up front, this over my maintenance term, and I'm deferring 2,400 until the expiration date. Now, that's how we, that's how we can recognize revenue for a bundle, for bundled performance obligations. Let's talk about contract cost acquisition. So there's a bunch of different ways people are going to do contract cost acquisition. A lot of people are going to just do it sort of at a high level, and the good news is any of the functionality I'm going to show you can be done at a high level. But we also have the ability to get very granular, where I can actually plug $12,000 of contract cost into a particular arrangement. And what that's going to do is it's going to defer that cost and map that to my revenue plans based off of my allocation ratio. So it took that $12,000 and 78.4% of that is 9408 mapped to my upfront plan. Then I've got 19.6 of that mapped to my maintenance plan, and 240 mapped to my SLA. So when I go to my forecast now and hit refresh, I can see that I now have gross revenue from my contract, and then net revenue from my contract after my amortized allocation costs. And I can group this in all sorts of different ways to get net contract, gross, to break it all out. I can filter this so I can only look at my cost components or only look at my revenue components, or I can look at all of my components. You know, when I go ahead and make when I look at that revenue arrangement now and I look at my revenue plans, I can see on my plan all of my expenses that are mapped to it. And at the end of the month or whenever this is scheduled, when I go to book my entry for A2 customer in April, I can see I'm going to also book my contract cost at the same time. So when I book that revenue entry and then I go back to my revenue recognition forecast and hit refresh, I can see my recognized revenue. I can see my recognized allocated contract costs. I can see what's still planned. And if I go to my income statement and hit refresh, I'm going to see I've got my revenue, and then I have my contract costs and my net income. So that was one way to show, you know, bundled performance obligations and contract cost acquisitions. Just another example I wanted to show, if I go back to my forecast here, and I just expand to include A3 customer, you'll see in this case, ooh, that didn't come over too good, but if I just correct the forecast, the formatting here a little bit, you'll see in this case, I'm actually allocating the entire contract cost amount over a 2-year term, which is the original contract in the renewal period. I know people have brought that up. They don't want to allocate it across the elements. They just want to take the whole thing over a certain time frame, and I've heard, you know, the original contract in the renewal period. So that's another way to view it, and we can do all sorts of different ways. So that really takes me to the end of use case 3, and we got through that pretty quickly. So lastly, and, you know, I should be able to get this done in just a couple of minutes, is I want to talk about the dual reporting requirement under ASC 606. Basically, you know, there's a dual reporting requirement and there's a dual revenue recognition requirement, you know, as you're transitioning from ASC 605 to ASC 606. And you can do it a modified retrospective method or a full retrospective method, but either way, you need dual reporting for the look-back period. And using NetSuite's multi-book product, we can have different revenue rules per book, we can have different revenue allocations per book, we can have different revenue planning and recognition and reporting per book, and then we have a very detailed transition plan for the cutover from 605 to 606. So jumping back into the product, I'm just going to go to my shortcuts here, and we're going to just go through this really quickly. But I basically have 2 use cases that I want to show that are very, very similar. In fact, the orders themselves, the source transactions, are the same. All right, my A4 customer, I've got a sales order, and I'm calling this 605 versus 606 with no VSOE. And then I also have a sales order that is 605 versus 606, where in 605, or you know, they were following 97.2 or using VSOE in the residual method. All right, so both orders are for perpetual license and maintenance. Both orders are for $12,000 total. But I've set up the items differently, so the rev rec is going to be quite different for both of them. So you'll notice that I don't have anything on my rev rec forecast right now. And let's just look at my first order where it's 605 versus 606 with no VSOE. So first, setup, right? Items, rules, fair value prices. So first off, on my items, I have a revenue recognition rule in my primary book, but I also have a different revenue recognition rule in my 606 revenue book. So straight line in my primary book, because I'm going to recognize the whole thing over the term. But in my secondary book under 606, I can recognize a portion of that up front. So I've got multiple rules per book. My maintenance item, I'm going to recognize it straight line in both books. It's just going to be a different amount, okay? So we've got items set up with different rules per book. And then we've got fair value prices. So if I look at my fair value price list, and I'm just going to change the view here to 605 versus 606, I can see that I've got different fair value prices in my primary book versus my 606 revenue book, and I can filter this. So in my primary accounting book, I'm just recognizing my perpetual license and my maintenance under this use case where there's no VSOE. I'm just recognizing it based off of the sales price in my 605 book, and I'm recognizing it whatever I sell it for, straight line. But in my secondary book, I'm actually recognizing 20%, so 20 divided by 100 times the transaction price for my maintenance. Oh, I'm sorry. I confused myself. That's a different use case. I apologize. In my primary book, I'm recognizing my perpetual license and my maintenance at the sales price over the contract term at whatever I sell it for. In my secondary book, for those same items, I'm calculating my best estimated selling price as a percentage of the transaction. So my license is going to be 80 divided by 100 times the transaction price. And my maintenance is going to be 20 divided by 100 times the transaction price. And we're going to use that relative fair value allocation to allocate. So 2 rules per book for each item, 2 fair value prices per book for each item. And when I go to my order now, and I hit approve, and I'm just going to let this process, I see that I have 2 revenue arrangements, one in my primary book and one in my 606 revenue book. And if I look at my forecast, I can see in my primary book, I'm just recognizing $12,000 over the contract term at the sales price because that was the rule I used, and I was not using any fair value formulas. But you'll notice this accounting toggle here. In my 606 revenue book, that same exact transaction, but because I had different fair value pricing and different rules, I'm actually recognizing my relative fair value allocated $9,600 up front versus my $2,400 over the contract term. So a very, very different set of results based off of my rules and my transactions and my prices. And if I look at those revenue arrangements, I can see that this revenue arrangement is very clearly in my primary book. This revenue arrangement is in my 606 revenue book, and I can see all the allocation detail is different, all the planning is different per book. Okay? Last thing I want to show, and then we'll be done. I'm going to close out that transaction. I go to my VSOE residual 605 or 606 transaction, and again, we're talking about items, rules, and fair value prices. So I open up my items, and since we used VSOE in 605 for this use case, I was already recognizing some of my license up front, and I was already carving out my VSOE for maintenance and recognizing it over the contract term. So my rules per book of upfront RevRec and upfront RevRec are the same because I was already recognizing a portion of that up front, and I was already recognizing my maintenance even periods, and I was going to continue to recognize that even periods in my 606 book. The difference really is in how the allocation is treated. So again, if I go to my fair value price list, and I apologize, I know I've been jumping around, and I go into this view, and I go to my primary accounting book. So in my primary accounting book under 605, I'm going to use the sales price for my license, and I'm going to use a VSOE price of 20% to carve out 20% of the total price and recognize that over the term. That's SOP 97-2, that's the residual method of accounting, and that's what we're following in the primary book. But in the secondary book, instead of just carving out VSOE, I'm actually using 80% of the transaction for my perpetual, 20% of the transaction for my maintenance, and using the relative fair value for my allocation. So even though the rules are the same, the timing is the same, my allocation is different. So again, here's my 605 or 606. I'm just going to hit approve, and because I set this up correctly, because my rules are set up, my items are set up, and my fair value prices are set up, all of this happens completely automatically. And let me just refresh this. Here's my revenue arrangements per book. Okay, and you can see in my primary book, if I look at my allocation detail, I'm using the residual method. And I'm basically calculating my fair value at $2,400. I'm carving it out of my license, and I'm recognizing that $2,400 over the term. Now, when I go to my secondary book, I think because I think it ended up being the exact same amount because I didn't pay much attention when I created the records. But the point is that instead of using the residual method, it used the relative fair value method to come to the prices, and we're getting the same amounts there. So I got to double check that. I think that's correct. I just noticed that, but it works. I promise you, and so we have different sets of results, different rules, and then additionally, when you rev rec and reclass, you're going to rev rec and reclass per accounting book, and you are going to be able to schedule that per accounting book as well. So I know I kind of had to rush there to get the end finished. The only last thing that I wanted to point out in a slide deck before I sign off and take questions is that we do have a transition path for the cutover. But basically, I don't have time to get into all the different steps, but we have a transition tool that will take those borderline crossover arrangements, reprocess them, and book the adjustment to retained earnings as you switch the methods, or you switch the rules and you switch the fair values to the 606. And whether it's full retrospective or modified retrospective, we do have an implementation plan in place to do all the dual reporting and to do the cutover. So please talk to your sales reps, talk to your sales engineers, get us engaged, and see how we can help you, get you on the module and get you 606 compliant. Thank you very much. So I'm not hearing anybody else. I am wondering if somebody's going to be opening it up to questions or if we're out of time. Is somebody on mute?
At this time, if you would like to ask a question, you may submit your questions via the Q&A panel on the right-hand side of your screen. Simply type your question in the open area and click Send to submit.
And it is at the bottom of the hour, so I believe we are going to end the call now. I have been monitoring the Q&A panel. I've been answering some of the questions. We will certainly look at all of them, and if we don't have time to, or if you're logging off of the WebEx now, you obviously won't see the answers, so we will try to consolidate those and get some answers out to those who have asked the questions. All right, so thank you very much, everyone, for your participation, and hope to talk to you soon. Thank you very much.
Thank you for joining today's conference call. This does conclude today's webinar. You may now disconnect.